Did you know that real estate has phantom losses? These phantom losses can reduce your tax liability tremendously. It's not a real loss. Now, because of that very reason, the IRS looks very closely at these deductions. The primary way that this is done is as a real estate professional, an REP. That's the way you're going to find out a lot of the rich people who own a lot of property, they pay zero taxes. In this video, I'm going to show you in 3 easy steps how to qualify as a real estate professional. If you stay towards the end, there's going to be a bonus. I'm going to teach you a very amazing way that I just found out about, where you do not actually have to be a real estate professional and still can deduct these phantom losses from your non-passive income. If this sounds interesting to you, please smash that like button, comment on this, and please share it with your network as well so other people can benefit. My name is Michael Wander, and I'm the founder of Wander CPA. For over 10 years, I've been helping people invest, save money on taxes, particularly in the real estate industry. Let me mention that there are 3 ways, and only 3 ways besides my secret that I'm going to tell you at the end, how to deduct these, quote, passive losses from your non-passive income. The first way is on the entire disposition of an asset in a fully taxable transaction. The second way is that anybody may deduct up to $25,000 from their non-passive activity, non-passive gains, as long as their MAGI, modified adjusted gross income, is below $100,000. It's reduced by 50 cents for every dollar above that. So at $150,000, they do not have any deduction at all from their passive losses. And the third way is to qualify as a real estate professional, which is what this video is about. That is just to let you know that there are a few other ways, but we are focusing on one specific way over here. So just as a reminder, if you did not do it already, please smash that like button, share this, and comment if you feel somebody else can benefit from it. The only benefit, the only compensation that I get from creating a video like this is by knowing that it's helping somebody. So if this is helping you at all, please do me a favor, hit that like button, let me know in the comments, and share it as well. Thank you very much. And with that, let's delve right in. So what are those 3 steps that are required in order to qualify as a real estate professional and be able to deduct your rental real estate phantom losses from your non-passive income? Those 3 steps are as follows. I'm going to list them out, and then we're going to go into detail defining the terms there and explaining them. The first step is that you must have 750 hours annually spent in a real property trade or business in which you materially participate. Second step is you must have the majority, that's 50% or more, of the time you spent throughout the year on real property trade or business in which you materially participate. And lastly, the third step is that each single one of your rental activities must have material participation inside of it. Okay. Before we delve into the details, it's going to be helpful to understand a brief history of passive activity losses. Prior to 1986, all income, passive or non, was considered equal. In 1986, Congress passed Section 469. Section 469 defines passive activities as follows: any trade or business in which the taxpayer does not materially participate, and any rental activity. So as you can see, those 2 key items, any rental activity, irrespective of material participation, and any business in which the taxpayer does not materially participate, are going to be considered passive activities and subject to the passive activity rules. Now, an unintended consequence of this rule, that's IRC Rule 469, was that a real, true, bona fide real estate professional was unable to deduct their passive losses, their real estate rental activity losses from gains they had in other aspects of the business. For example, a builder who kept a few properties for rentals, they were not able to deduct those losses from the rentals against the gains they had from the sale. Now that did not seem fair. So what Congress did is they passed in 1994 Section 469C7, which says, and I quote, "The committee considers it unfair that a person who performs personal services in a real estate trade or business in which he materially participates may not offset losses from rental real estate activities against income from non-real estate activities or against other types of income such as portfolio investment income." In short, they saw it was unfair, and so they changed the rules. Now, that's when the real estate professional status qualification comes in. So it's important to recognize that the intent of Congress was to provide a method, a way for a real estate professional to deduct their rental real estate losses. Now it's turned into an attractive way for people to see if they could qualify, see if they do qualify as a real estate professional. So step number one in qualifying as a real estate professional is you have to have 750 annual hours in which you materially participate in a real property trade or business. What is material participation? There are 7 tests, and you must meet at least one of them. 7 tests are: the individual participates in the activity for more than 500 hours during the year, which is about 42 hours per month. Second one, individuals' participation in the activity for the taxable year constitutes substantially all of the participation in such activity of all individuals for such a year, right? So the individual's participation constitutes substantially all of the participation of all individuals for such a year. That could be one that is beneficial for myself and for some clients. Number 3, the individual participates in the activity for more than 100 hours during the taxable year, and such individual's participation in the activity for the taxable year is not less than the participation in the activity of any other individual, including non-owners, for such a year. So the third one is that the activity has to be for more than 100 hours, and it's not less than the participation of any other individual. Okay, so 2 and 3 seem to be kind of similar, have a little bit of overlap over there, except number 3 has that 100-hour threshold, but I'm sure there's some specific details over there that would have to be looked at. Number 4, the activity is a significant participation activity. That's a legal term, a tax term, significant participation, so pay attention, and that is something we will discuss a little bit later, not with respect to material participation as we're doing right now, but with respect to the bonus at the end. So number 4, again, is the activity is a significant participation activity for the taxable year, and the individual's aggregate participation in all significant participation activities during such year exceeds 500 hours. So regarding significant participation, exceeding 500 hours. Number 5, the individual materially participated in the activity for any 5 taxable years. Seems a little bit kind of circular. We're saying material participation is an event. You have to materially participate in the activity for any 5 taxable years, but okay, during the 10 taxable years that immediately precede the taxable year. 6, the activity is a personal service activity, and the individual materially participated in the activity for any 3 taxable years, even non-consecutive, preceding the taxable year. And lastly, 7, based on all the facts and circumstances, the individual participates in the activity on a regular, continuous, and substantial basis during such year. So a few more things about material participation. I know that was a lot of jargon, but a few more things is that really they define it, the IRS defines it as any work that you do in connection with an activity in which you own an interest. Meaning an interest, so if you are an employee performing tasks that would generally fall under material participation, you are not able to count those hours for your real estate professional status hours unless you are at least a 5% owner of the business in which you are an employee. Got it? So you have to own the business in order to use those hours for your real estate professional hours. And lastly, significant and continuous participation. That's basically the intent. Always keep that in mind, the intent of the IRS when they created these rules. Now, next definition, second definition, okay, just one more, bear with me, is the real property, right? So again, you have a real property, trade, or business. That's also specifically defined. There are 11 examples that are given, and they are as follows. There's development, real property development, redevelopment, construction, reconstruction, acquisition, conversion, rentals, operation, management, leasing, and brokerage. Those are the 11 examples that are given. We're not going to go into detail about what each of those need to be, what different activities within that qualify, don't qualify. That would be for a different time. That would be for a different video. But that is basically the definition of real property, trade, or business, and that is the definition of material participation. So again, in summary, step number one to qualify for a real estate professional is that you have to have 700 annual hours in a real property, trade, or business, as we defined it, in which the taxpayer materially participates. So that is step number one. Again, if you haven't done it yet, please smash that like button, share this, comment, do that. And another comment, another note, a spouse. Can a spouse qualify for the material participation or for the real estate professional status? Now, it's interesting, one individual, one of the spouses needs to have the full 750 hours. They need to qualify as a real estate professional. However, as far as the material participation qualification goes, a spouse is able to, you are able to use your spouse's time spent on a rental real estate activity. If it was material participation, you can count, the real estate professional can count those hours, can count the hours spent by the other spouse to qualify that property as a material participation property. Let me say that one more time. A real estate professional spouse can count the hours spent by their spouse, their non-real estate professional spouse, those hours spent on a real estate rental in which that spouse materially participated, to qualify that property as a material participation property, to include that property and deduct those losses from the non-passive income. I know that's a lot. Listen to it again if you need to. So there we go. Now we are going to jump on to step number two. Step number two is that the majority of all the taxpayers' hours, personal service hours, have to be spent in a real property, trade, or business in which they materially participate. So for example, a full-time employee who's working 40 hours a week, not in a job that they own, not in a business they own, would have to work an additional 41 hours on real property, trade, or business and materially participate. So that's a total of 81 hours per week, which you can see makes it very difficult, if not impossible, for somebody with a full-time job to qualify as a real estate professional. Now, if somebody, for example, worked 20 hours per week, they would only have to work 21 hours on a real property, trade, or business, keeping in mind if you have a seasonal job, such as teachers, that the IRS does consider prep time. So a teacher could not just say, oh, my hours are 20 hours per week in class, and then the rest of my time is spent preparing for or on a real property, trade, or business, without showing that they do spend time on preparation, which the IRS realizes is a reality. Something to keep in mind. Now, this might be a good time to discuss substantiation. What is substantiation? It's basically your ability to show, to prove to the IRS that what you are claiming, the time you are claiming, is accurate. So this is the way the flow usually goes if the IRS is auditing somebody. First, the taxpayer is going to claim real estate professional status. Secondly, the IRS disputes it. At this point, the burden of proof lies with the taxpayer. They have to substantiate their claim. And they can do such with receipts, with logs, calendars, emails, many different ways of doing it. But usually something that has to paint a complete picture that tells a consistent story. The IRS can call character witnesses, and what they are trying to determine is, and they can use their own discretion, is if the taxpayer is credible. So if somebody is trying to game this system, it's going to be very difficult, and they're setting themselves up for difficulty later. But it's an amazing opportunity for somebody who's actually trying to become a real estate professional. So now back to the substantiation. By the taxpayer providing the IRS with proof, with substantiation, the burden of proof falls back on the IRS to dispute that. And that's basically the position that me as a taxpayer want to be in. We want to have all of our support that paints a consistent picture available to give to the IRS if necessary. Now, also, in order to substantiate, for the second point of becoming a real estate professional, in order to substantiate that the time spent as a real estate professional or on real property, trade, or business is more than half of the time the taxpayer spends on personal service activities, they must also keep a log of their non-real property, trade, or business hours. Does that make sense? For example, if you're saying, hey, I spent 21 hours on real property, trade, or business, the IRS is going to say, well, hey, how do I know you did not spend 30 hours on in a different field, in a different personal service activity? So you have to have a log, a credible log, showing the hours spent on your non-real property, trade, or business activity. Calendar invites, emails, anything like that is going to be fair game, is going to be very helpful. Phone logs, if those are available through your provider, is going to be very helpful. So that concludes our step number 2. Now for the third and final step, which is shorter than the first two because we've already gone over the definitions, is that the taxpayer has to materially participate in each of the real estate rental activities. So recall that a spouse can be used to pull in the rental real estate activity of a activity that the real estate professional did not materially participate in. Now there's one exception to the rule that each rental real estate activity has to have material participation, and it is a real estate professional can permanently elect to combine all of their rental real estate activities and have them be considered as one activity. There are some tax implications, permanent tax implications, so before making such an election, please delve into that topic a lot more carefully. And that is basically the 3 steps. Now, there's a few caveats that I'd like to mention. One is that recall that material participation had 7 tests. One of them was that a taxpayer had to spend 500 hours on the activity. But the real estate professional requirement requires 750 hours. So don't get confused with the material participation test and the real estate professional status qualification. If a person uses that first material participation test and they have 500 hours in real estate activities, they still have to have material participation of an additional 250 hours in a different real property, trade, or business in order to qualify for real estate professional. Got it? Okay, moving on. A limited partner. If somebody is a limited partner, they can only establish material participation in that activity by meeting, there's number 1, 5, or number 6. We're not going to talk about it again. You can look back, you can look it up, either material participation tests 1, 5, or 6 in order to deduct those losses if you are a limited partner. Now, this last point is that even if a taxpayer materially participates in the rental real estate, it's still going to be considered passive if they're not a real estate professional, right? We know that. And conversely, if a real estate professional, if somebody qualifies as a real estate professional, but they do not materially participate in the rental activity, then they will not be able to deduct those losses from the non-passive income. Just 2 sides of the same coin. Now, we're going to get into the real estate passive activity tax hack. Are you ready? Are you ready? Let's do it. Now for the moment we've all been waiting for. There is an activity, there is something that would allow you to take rental real estate losses and deduct them from your non-passive activity, and you do not have to be a real estate professional. Are you ready? And it is called a short-term rental. Anticlimactic possibly, but listen up. Not just any short-term rental. There are 3 amazing outcomes of being very particular with your short-term rental and knowing what the rules say. So when Treasury Regulation Section 1.469-1T-E32A blah said that a rental activity, if a rental activity is less than 7 days on average, it's not considered a rental activity. If you are renting a home or a property for less than 7 days on average, then it is not considered a rental activity. Now, what does that mean exactly? There are 3 potential implications. One is, do the hours on it count towards the real estate professional status? 2, where does it go? Does it go on Schedule E or Schedule C? And 3, what do the passive activity loss rules, how do those rules affect this activity? 3. So the first answer is, does it qualify as real estate professional status? You want the short answer? It's yes. You want the long answer? You want the explanation, the reason why, which is super fascinating because the courts didn't think it did initially, is in 2001, Bailey versus the commissioner, the court determined that it could not. Why? They said because of the fact that it's not a rental real estate activity, then the taxpayer could not aggregate the hours, could not aggregate that rental real estate activity for the short-term rental with the other rental real estate activity. And thus, that was proof to the courts that it should not qualify. The time spent on that should not qualify for the real estate professional status. However, in 2020, not sure exactly when this was, but the Lucero versus the commissioner, they determined, right, that the real property, trade, or business has its own qualifications, which is material participation in a real property, trade, or business, right? So in order for the real estate professional status, you had to materially participate in a real property, trade, or business, of which short-term rentals is one. So therefore, overturn the previous court, and it does qualify for real estate professional status. Second item, which schedule should it go under? If you're familiar with Schedule C and Schedule E, Schedule C is for a business, actually significant participation. There goes that word again, that term again, significant participation. So, if you are providing significant services, to your renter, such as maid services, then it would go under the Schedule C. If not, it should go under the Schedule E. The difference as far as taxes goes is the Schedule C is going to have about over 15% in self-employment taxes. Schedule E will not. So if you wanted to go under the Schedule E, do not provide significant services. If you want it to count towards your 750 hours real estate professional status, make sure you are materially participating in those. And you have to understand the difference is how you materially participate. For example, taking out the trash is not a significant service that is specifically called out in the Schedule E instructions, but that would qualify as time spent for material participation. So you want to make sure that you are materially participating, but you're not providing significant services if you wanted to go under the Schedule E, but you also wanted to qualify for the 750 hours REP status. Lastly, what do the passive activity loss rules have to do? How do those rules affect a short-term rental that's not considered a rental according to the Treasury because it's less than 7 days? Well, here is very interesting. So, because it's not considered a rental, then you would be able to deduct those phantom losses, those losses against your non-passive income. It's not a rental. It's not a rental. So it doesn't even fall under the passive activity loss rules. When that rule was created, the passive activity loss rules, that was a 7-day or less, average 7-day rental was explicitly excluded from those. So it falls back to way in the beginning when I mentioned the history, when all losses could be deducted from your any income. It's completely excluded from it. So that activity, losses from that activity can be deducted from your non-passive activity. And in closing, thank you very much for staying with me till the end. And if you enjoyed this, if you learned something from it, please let me know in the comments. Please hit the like button, share it if you know anybody that might benefit from it in your network. And if you want to get a hold of me, you can reach me at michael.wander@wandercpa.com. I'm on Facebook, I'm on LinkedIn, active on TikTok and Instagram as well. And I look forward to hearing from you, and keep your eye out for additional movies coming out. Have a great rest of your day.